extending time horizons are critical to building wealth. That was one of your recent reports. Talk about time horizons and why they make such a big difference.
There are these little things that people can do that make building wealth so much easier through time. And the data show very clearly that extending your time horizon reduces the probability of losing money. Literally, as you go from 1 day to 1 week to 1 month to 1 quarter to 1 year to 3 years to 5 years to 10 years, your probability of losing money goes down. In a 1 day time frame, you're basically flipping a coin because the economy doesn't change in a day, right? Companies really don't change in a day. It's all noise that you're trading around. But as you extend your time horizon, you're actually beginning to invest for fundamentals. We think that's critically important, and the data show that for not only just for stocks, but even for fixed income, for emerging markets, for U.S. stocks are saying, but for emerging markets, all these different kind of asset classes and sub-asset classes, extending your time horizon is one of the easiest things to do. I don't understand why people trade frequently. I think they should invest and then go play golf and just have a better life. I mean, why are you in your basement trading stocks? You're not going to help your performance through time. That's what the data shows. And you're probably not as physically fit as if you were out playing golf or cycling or doing something.
You wrote a book, Rich, in 2001 that you updated in 2005 called Navigate the Noise, Investing in the New Age of Media Hype. That was so prescient. I mean, it's just gotten so much worse. How does one navigate the noise?
What the book tried to focus on way back when was the basic rules of building wealth, and they're not very difficult, so why don't people do it? And the answer is there's always kind of a siren song telling them there's something new and better and exciting, and another portfolio, crashes on the rocks. That's kind of what happens. And so, but why does that happen? Why is there always this siren song? How do you get rid of it? And so, I think in mythology they put wax in their ears, and so they didn't listen to the siren song. And that's right. Kind of what the book suggests is, there are simple things that we can all do. Extending your time horizon, compounding your dividends, realizing that cycles repeat and we're not on some new age and the book kind of goes through that and just says, do these simple things versus where we were 15 or 20 years ago. As you correctly point out, media has mushroomed. Financial media has absolutely mushroomed. I just think people should really ignore most of what goes on, realizing that the economy doesn't change dramatically in a day, let alone in 10 minutes. And that's the kind of stuff that people should wean themselves off of.
But, navigating the noise, there are sounds that you do pay attention to.
I would say there are a couple of things that are kind of basic things that people should pay attention to. Number one, I don't think people should pay attention to the presidential election. I hate to say that. I don't think it's very worthwhile. The reason I say that is in my 40-odd year career, the losing side of a presidential election always says the market's going down. Never fails. So for me, the first one would have been Ronald Reagan and Jimmy Carter. Ronald Reagan wins, we have a bull market. Then we get to Bill Clinton, we have a bull market, right? We get to George Bush the second time, well, okay, maybe we had the lost decade. Okay, maybe that doesn't fit all that well. We get to Barack Obama, we have a bull market, right? We get to Trump, we get a bull market. We get to Biden, we have a bull market. I mean, I think people get too wound up about this. So one of the things I suggest people do not listen to is the political aura that goes on, the noise around politics. It's fun, it's interesting, I get it, but I don't think it's going to help your portfolio. The other thing I would suggest that people do look at are leading indicators of the economy. There are leading, coincident, and lagging indicators of the economy. Leading indicators, as the name implies, lead the economic cycle. Coincident, move with the economic cycle. Lagging, move after the cycle has moved. Investors should always look at leading indicators. The stock market itself is a leading indicator. I've always been fascinated that investors tend to focus on lagging indicators. What are lagging indicators? Inflation, unemployment. The Fed itself is a lagging indicator historically, right? What are leading indicators? Weekly initial jobless claims, building permits, right? I mean, things that kind of lead the economy. Second thing I would say is an investor should focus on profit cycles and not economic cycles. You hear tons about the economic cycle, but really don't hear very much about profit cycle. And if you're an equity investor, profits are much more important than GDP, right? Let's remember what equity investing is all about. Equity is about becoming a partial owner of a company. And as you become a partial owner of a company, all you care about is the profitability of the company that you own. So I would say ignore politics, look at leading indicators, and look at corporate profits.
And I think that you told me that the opportunity set is the broadest it's been in our lifetimes.
In a generation, for sure.
In a generation.
If you think of the markets as a seesaw, and normally this doesn't matter. You don't have to think of the market as a seesaw, but the market has become so, what people like to call bifurcated. We've got these 7 stocks, and then we've got everything else in the world. The 7 stocks are so dominating the indices and dominating the overall market that the opportunity set in everything else is like historically broad and historically attractive. And so this does not happen very often. And the way that I think your viewers should think about this, are there really only 7 growth stories in the entire global equity market? Right? Of course not. There are tons of growth stories out there, but nobody's interested. That, from our perspective, presents tremendous opportunities. And that's where our portfolios are focused, right? Our investors don't necessarily want us to follow 7 stocks. We're not momentum investors. But this other side of the seesaw, people have virtually no exposure to. It's an amazing opportunity.